I will try to explain you some of the concepts that are present in the dashboard. So let's go. Don't hesitate to put some comments and ask questions. I will take your questions and comments into consideration for the next week. If you are interested in what the dashboard is bringing, if it's interesting for you, if it's not, what you would like to see, and then make this evolve to something that is more interesting for you, because this is the kind of stuff that I do, that I look at, but I also want to do something interesting for you, and at the same time maybe I can find something interesting, what that's interesting for you, but also for me in your suggestions. So don't hesitate to put comment and ask questions, and we'll go from there. I will go full screen here, just for you to be able to see the numbers. So what do we have here in terms of dashboard? So we have multiple columns with the last price, the variation on 1 week. So last week you see on equities, SPY Qs down 1%, 3.4% on the Qs. Emerging market went down as well. So you still have the variation on 1 year, 5 year, one column that tells you how far away we are from the all-time highs. So for instance, here for the S&P or the SPY, you will see that we are only 2.62% away from the all-time high, which is not dramatic, I guess. So this is why it's colored in green. When you below 5% of the all-time high, like the Nasdaq is at this time, it's down 5.57% from the all-time high. You know, I put this in white. I mean, it's not bad, it's not good. let's put it that way. For instance, if you look at TLT, for instance, which is the long-term bonds ETF, you can see, even if it recovered, it's still 40%, 38%, 39% away from the all-time highs. So yesterday it was, last week was 40-something, 44%, I believe. So that's a huge drawdown for the bonds. And again, that's what killed the risk parity and the 60-40 portfolio, at least for the last 2 years, so 2.5 years. So we'll see if it comes back now with the new decorrelation between these two asset classes. I also put in this dashboard for the numbers. The sigma, the volatility ratio. What is it? The volatility ratio is the ratio of short-term volatility versus long-term volatility. It tells you if it's above, if we are basically in tension. If this ratio is below 1, then this means that you're not really in tension market. But when this ratio is going above 1 and significantly above 1, this means that the market is in tension. But maybe even more importantly is the ratio. This ratio change week over week, because it tells you where this ratio is going. And with the increased volatility we had this week on the equity markets, we see that this ratio has been increasing and is going closer back to the parity. So meaning the volatility long-term versus short-term versus long-term volatility is going closer to 1. So the idea is to say that if this one is going up, continues to go up, this indicates tension in the market, and maybe more aware about the risk in the market that is happening. I have a similar indicator on volume. When volume are increasing, it shows again that the activity is increasing on this specific instrument. So I think both are interesting in telling you where the action is happening on specific instruments. Here, for instance, if you look at the S&P, you have the volatility ratio going closer to 1, maybe becoming above 1 pretty soon if volatility keeps rising. So this ratio is increasing. At the same time, the volume, is increasing as well. And you can see that maybe except the Qs, the volume is increasing on all of the equities ETFs that I have here. And the sigma ratio is also increasing on all the equity instruments that I have here, which means that it's getting more active on the equity, so it is time basically to pay attention. We have EEM, which is the emerging market ETF that is above 1. The FEZ, which is Eurostox equities, that is the ratio is above 1 and rising. But I mean, it's not necessarily a concern, specifically if you look at the Eurostox. The Eurostox recovered was doing pretty well recently, so that's part of volatility can be on both sides. It's more indicators of activity. So when you want to have an idea of where the action is going, that these two are interesting indicators, if you want. So we have the same thing, on all so I did this on same thing on all asset classes. That being said, if you want to have more instruments, some specific instruments that you think that you would be interesting to look at in these in the dashboard, that would be again interesting. So I have the same thing on bonds. Aggregated bonds, mid-term bonds, long-term bonds, tips as well. So we have the drawdown on the long-term bonds that we've mentioned before. Over 5 years, long-term bonds have been down 31%. It's over 5 years, right? Obviously, it's happened more in the recent times after 2022. But it's when you have down 30% of 5 years, your portfolio gets hurt. TLT, again, volatility ratio is above 1 and increasing. So the market is getting more active on equities, is getting more active on bonds as well. So the volume ratio is increasing as well. So you see that the market is getting more active. Something is reshaping at this time. Commodities, we have kind of a similar picture. This was a kind of risk-off week where you have, whether it's the general commodity index, DBC, or gold or oil, all were down on the week. Volatility increasing and volume globally increasing as well. Maybe except oil, because oil is back, like I've showed you many times, within its range, meaning that it's less interesting in terms of big moves for market participants, specifically if you want to capture large moves or large trends. This is kind of a similar thing on Forex. I will talk very rapidly on Bitcoin, that is now down. That was down around the 81s yesterday when I made the snapshot. It's only 21% down from the all-time high that were so on a weekly basis again. So don't tell me that the all-time was not this. I snapshot this on a weekly basis. So we're only down 21%, which, considering the volatility of Bitcoin, is not massive. I will make a little bit note on that later. You can see that the volatility is increasing despite the sigma ratio. The volatility ratio between short-term and long-term is below 1 quite significantly at 78%. But why? Because with the institutionalization of Bitcoin, we are in a long term, and with more market participants in this specific in the cryptos, the volatility is naturally going down. So it's totally natural that the short-term volatility is being lower than the long-term volatility. Now, what's more interesting, like I said before, is that we see that this ratio is changing on the upside. It is increasing. So it's increasing on the upside. It's also the volume also increasing significantly. So again, market getting more active across the board, whatever asset class you are looking at. Now I want to show you a couple of things that I think are interesting. So here you have ETFs since 2024, the beginning of 2024, that are representative of some major asset classes. So you have IBIT, which is crypto, you have gold, so metals, you have the S&P, you have UUP, which is the dollar index, you have USO, which is energy, and you have TLT, which is long-term bonds. So where are we now? So this shows you basically what the momentum has been on every single of these instruments. You see that IBIT, for instance, is still up 92% despite being down 20%, like I just said before. The S&P has been up 26% over the last year and 2 months now. Gold 40%, overperforming the SPY. So it's brutal raw number of momentum, if you want to see it. Why do I show you this? Because I wanted to show you kind of a concept which is risk-adjusted momentum, which is what most it's the basic indicator of the way most commodity trading advisors, CTAs, are seeing, trend followers are seeing the market, which is a momentum indicator divided by the volatility. So it's a risk-adjusted momentum indicator, which is kind of more interesting because it gives you an idea. I mean, every CTA has his own, I would not say secret sauce because I don't believe in this secret sauce, but as is only every CTA has his personal way, specific way to address and to calculate momentum and to calculate the risk. And again, if we take the turtles aside who have a different investment process, most of them, the quants are doing some kind of indicators of momentum divided by the risk. And this is what we see here. So why is risk-adjusted momentum for the dollar much bigger than the gold, for instance, when you see that the US dollar basically increased by about 12% when gold increased by 39%. Why? Because the FX volatility is much lower, and so this mostly represents the kind of exposure. It gives you an idea of the exposure you would have in a CTA portfolio. So where you need to adjust the risk on every component. So you would have more, for instance, dollar exposure in your portfolio, then you would have gold, because you have to adjust the risk of your component. Here you see the SPY dropped in terms of risk-adjusted momentum this week. This was obviously based on two factors. The momentum dropped because the index dropped, and like we've seen in the numbers, the first one of the first table on the dashboard, that the volatility also increased. And so when you have a decrease at the numerator, if you want, decrease in momentum and an increase on volatility, you have both side effects where this decreases significantly your risk adjusted momentum. On the opposite side, you have we've seen that on TLT, the long-term bonds, we had momentum increasing and even volatility increasing as well. But at this time, the momentum, the pure raw momentum factor, was much bigger than the volatility increase. And so we have this recentering to zero at this point. So I think that what's interesting is not really to see the levels where it is, although it might be interesting. I believe that what's interesting in this is to see where the potentially some market actors like trend followers that are doing that style of investment are going. What does it mean? It means that because, for instance, on the equity markets, because the momentum is slowing down and the volatility is going up, so you have a significant decrease in risk-adjusted momentum for US equity markets, there might be some selling pressure from the CTAs on the equity market. So you will see, if you look at the two that moved significantly this week, you have risk-adjusted momentum for the equities going down. You have risk-adjusted momentum for long-term bonds going up. So you may be in a situation where you will have some reallocation from equities to bonds at this point. Again, the main driver will be what the Fed is doing. So if tomorrow you have someone of the Fed saying anything about the markets, the picture may change radically from one day to the next. But again, this is to give you some clues about that. Again, let me know in the comment if that kind of thing has any interest for you. I think it's interesting because it helps you figure out where the markets are going, which is where we want to know. I mean, it's always interesting to know where it is, but it's more interesting to know where it might potentially go. Remember, it's not an investment advice. I need that little disclaimer. I'm just explaining the markets here anyway, and give you more clues than you may find anywhere else. So next we can go on spreads. So my basis for this on equities is to look at the markets versus the S&P. So you have the S&P that went down. You have the Nasdaq that went down against the S&P this week. It's not totally surprising, considering that the beta of the Nasdaq is above 1, so it's much more volatile, and so the moves in the Nasdaq are bigger than the ones that have happened in the S&P, so that's not surprising. The interesting point is that the small caps underperformed again significantly the S&P. It's not really surprising in the sense that when you have market stress, markets going down, it's natural for investors to go to the kind of safer stocks, which means more large cap indices, so from small cap to larger cap, which is the S&P 500. So that explains a little bit as well the rebound that we have in the Dow Jones Industrial Average versus the S&P. What can we do next? So we have similar chart on for European indices. So you've seen that from the beginning of January, we have a strong comeback of European indices versus the S&P. So FEZ is the Euro stock. You have EWQ and EWG, which are Germany and French index at the same level. They are coming back as well, probably on the expectation on the resolution of the conflict. The markets were closed at this time when the Zelensky-Trump spat happened. It will be interesting to see what the market reaction will be on Monday on the European equity markets. If it was just a stunt by Trump and Zelensky that will go back to the negotiating table very soon, or if this has an impact on the European market. But whatever, the term that you see, if you see that on the last maybe 20 years, there is the US market and the rest at this point. What else can we look at? We can look at everything in the context of gold, which is always interesting, specifically considering the fact that the US is flooding the market with cash. So gold is the reference. So if you look at the S&P versus gold, basically it's been flat since 2021, up 10%. Again, this goes back to gold going up significantly, but for the same reason again, which is flooding the market with cash and inflation. So you have the Euro stocks not resisting so well, and the US dollar not resisting so well for exactly the same reason as the S&P. And that graph also shows that most of the growth after the COVID crisis on the S&P came from debt on the markets. It didn't come from actual growth, which is the most concerning. So if you want to have equity stock markets in the US going up, the Fed basically has no choice. And we know what the stock markets represent. It's all the 401k. Everyone has this. That's what investment advisors do. They put. So until recently, they were mostly putting, 60-40 risk parity and other portfolio, but, most RIA portfolios, investment advisor portfolio, are following the market. So the US cannot afford having a stock market going down. This will bankrupt every single American in the country. And this is why they have to pump it always. So again, that needs to be taken into consideration, in my opinion. So this was the recent action. So we've seen we had correction this week with a rebound yesterday, but still volatility, implied volatility going up. The rebound yesterday probably doesn't mean much at this time. I always talk about smart markets and and dumb markets. I consider smart markets, bonds market, and volatility markets, when equity markets are more dumb markets, if you like. Many we won't like this, but that's just my appreciation of this. So I think it's more interesting than yesterday, the bounce back on Friday, which probably includes some window dressing at the end of the month for fun, that some of them desperately needed, a better print that was expected than what was expected on Thursday. But the volatility market doesn't show any sign of relief at this point, as you can see. So I don't think that yesterday's rebound meant much. We'll see what happens next week, but probably this one didn't mean much. This is again an explanation of what I wanted, what I told you about, about the volatility ratio at the beginning of the dashboard. You can see that both short-term and long-term are converging together, which means that we are at a point where basically we don't know where we're going at this point. It can be still going up if the market volatility recedes and calms down, or it could be going significantly, equity markets could be going significantly down if the market, if the volatility is still increasing. So you see this, there are a lot of clues about the market doesn't know where it's going, and it's kind of a risky environment. We've seen this on the activity indicators, the exchange ratio on volatility, on volume, making the case that the market is getting more active. Now we see this on implied volatility, where despite the rebound, implied volatility was slightly up yesterday. So at least it did not recede like the market. And then we see this on not only on implied but historical volatility, but this one is more or less another way to see the same thing that we've seen in the dashboard. Another way to see this is to look at the VIX term structure. So the market is expecting the same volatility today as is expected in 1 month. Usually the uncertainty is bigger in the future. This is why you have this contango structure for volatility for VIX futures. Now there is some stress at the short term for the first expiration of the futures, so it starts getting slightly in backwardation, at least for the two first expiry of the VIX futures. Obviously that is not really dramatic at this point, but it's interesting to be noticed that for the next months at least, the market is expecting anything. Basically they don't know. It could be as much going up or down, but they have no view. This is what I want to say. They have no view at this point about the next month. Because, for instance, I wanted to show you this, which was the VIX back term structures that happened in August 2024 last year, when the market went down in a couple of days 10%. So August 5th, you see that the term structure was in a clear backwardation, so which indicates a lot of stress in the market. What was interesting is that, but that's not the point for today, but the term structure reverted to something more let's say normal pretty rapidly in a very short period of time, when usually it takes much longer. And this is also explains why many volatility strategies have been caught in that kind of event, because it was very unlikely again, if you remember, it was induced by the Bank of Japan saying, okay, we don't play with this anymore, we won't increase interest rates, and this calmed down the market. The talk of the day at the time was about the carry trade unwinding. I just showed you this just to look to show you how a backwardation term structure looks like in terms of intense stress in the market. Obviously, when you look at this, we are not there yet. This just means that the market has no expectation, has no idea about the next month, because after that, the term structure is looking perfectly normal, no stress for the long-term future, only for the short term at this point. What else can we say? Yes, I mean, I took the opportunity of this to show you this. This is the spread between gold and silver. And why do I show you this? Because I don't want to talk about silver. There are gold bugs, silver bugs. So the silver bugs always say that silver is way better than gold for whatever reason. The only thing is that they are basically kind of the same. Silver is gold with more volatility. And this is what the spread tells you. The spread has been between gold and silver has been evolving between 0 and minus 10, 20% for the last 20 something years. The beginning of the chart is in 2004. 2018, sorry. But basically this shows you that it's flat. It's doing the same thing. There's no better option in trading silver and versus gold, and this is why and actually when you are trend follower and the volatility is bigger in one instrument than the other, it's always easier to trade the smaller volatility instruments. So the way to trade silver and gold, in my opinion, this would be probably an approach that would be implemented in a hedge fund. Here, I mean, without testing much, do statistical testing about co-integration, you see that you have some form of co-integration between silver and gold. You have silver, hovering around gold, which means that you can potentially play mean reversion. And that's, I believe, that's how a hedge fund would play this, silver versus gold. But if you take them separately, again, they are the same. The spread is, hovering around 0. There's no added value, in my opinion, unless someone can say something in the comments and convince me otherwise. There's no added value to trade silver. It's even less interesting in the sense that being more volatile, it may gives you less quality signals about where the price is going. Basically, there is much more noise in this. So this is my explanation of why I will not talk much about silver anymore. I wanted to say this because I see a lot of, I often see posts on LinkedIn about silver and that kind of nonsense. But I will stop there. So my last point was about Bitcoin. We've seen Bitcoin is down 20%. Everyone was getting crazy. If you look at the median drawdown for Bitcoin, it's around minus 50%. I don't have the exact numbers. I think it's minus 49 something. But anyways, it's minus 50%, which means that when you are investing in Bitcoin, you spend as much time in a loss of more than 50% than you spend in a loss smaller than 50%. So at this point, we are down 20 something percent on Bitcoin. That's not a big deal. Even if Bitcoin would go back to a drawdown of minus 50%, which would take it around 50k something, that would not be a big deal. And I wanted to address, another post that I've seen on LinkedIn this week, which was about, drawdown of 20%. Again, not material for Bitcoin considering its volatility, but the same post is coming over again about the tulip effect, the tulip bubble. I mean, the tulip bubble, the tulips never recover, right? The difference with Bitcoin, you have, if it was comparable to tulip bubbles, it would have many tulip events in a row. So you would have one in 2011, you would have one in 2015, you have one at the end of 2019, another one at the beginning of 2020, another one around at the turning point of 2023. So you would have multi-tulip events, and so far Bitcoin always recovered. So only, in my opinion, that negates the point of this being a tulip bubble. Tulip bubble just, it goes to the roof, it explodes and never comes back. Bitcoin came back. And again, my advice would be, considering the facts that you have here about Bitcoin, and if you want to stay long only, if you cannot bear that kind of risk, just don't invest in it. It's that simple. The max drawdown is 90% of the whole time highs. If you want to limit your risk, just take a tiny part of Bitcoin if you still want to get into it. Nobody tells you to be 100% invested in this. But like the risk-adjusted momentum that I've showed before, I can show you that, by the way. Where is it? I'll try to go back on the risk-adjusted momentum. The risk-adjusted momentum for Bitcoin was actually very low. But why is that? So I told you that it might give you some indication about the positioning of CTAs in a market. And if you look at the allocation, what could be, an indication of an allocation of a CTA in Bitcoin. Again, this is not a target allocation. This is not an investment advice. This is just an indicator. Something that would go into CTA strategy would be more complex. So it's only an indicator, but you see that the risk-adjusted momentum is always very low. Why? Because the volatility of Bitcoin is much higher than any other asset in your portfolio. Obviously, much more than the US dollar, much more than the S&P 500. So if that would give you some kind of allocation here, the max allocation would be around 3, 4, 5%, considering the momentum, risk-adjusted momentum of Bitcoin, because when you compare to absolute momentum, it definitely beat any kind of other asset that we have here. But considering the risk, that just tells you that you have to have an allocation. When something in your portfolio is much riskier, you have to have an allocation that is much lower than any other thing allocation in your portfolio. So basically, this is where I wanted to go with this new kind of indicators that I wanted to show everyone to give you a better understanding of the market. Again, this was not any kind of investment advice. This is just for information, education, again, to better help you understand the market.